Yes, yes, you are welcome to this Financial Freedom FS, and I'm going to be teaching a lot of things under this platform, under this video. I'm going to be teaching Premier, Discount, Fair Value Gap, Order Block, Breaker Block, Break of Structure. You can see the abbreviation here, Change of Character, Top Down Analysis, AMD, Accumulation, Manipulation, and Distribution. This is how non-commercial trade. We have commercial and we have not commercial. Commercial are those who does not involve in trading, but they involve in other businesses that are not like trading. They're not in line with trading. But we have no commercial. No commercial are traders, and these are big banks. These are. Don't let it confuse you. Yes, commercial are not involved in trading like that. But non-commercial are the ones that are into trading, forex, trading cryptos, trading stocks. They are called non-commercial. But commercial are those who involve in big company, those who involve in personnel management and many other things. But non-commercial are those who involve in trading. And the major non-commercial are the big banks, the central banks of every country, BlackRock, those big company. They are the one that control the market. They are the one that determine the movement of the market. These non-commercial are very, very important that you have to understand the way they trade and follow them. They are the way in the market. They are the sack in the market. They are the one that determine the movement of the market. They are the one that make you to know when the market is going to buy or sell. When you see big momentum in the market, these are not commercial. They are the one in charge. I am going to be showing you how to use COT report under this training, maybe the second video, how to use COT report very well, because these are what non-commercial use to determine their movement. And you, as a trader, you must understand the way they move. Now, we have retailers. We are the retailer, like individual, like me, like you. We are the retailers that are not trading with big volume of money. Non-commercial trade with millions. They trade with millions of dollars, thousands of dollars, millions of dollars, billions of dollars. As you know that in forex market, $7.5 trillion is traded per day. $7.5 trillion is traded per day. And $7.5 trillion, only out of this $7.5 trillion, only 2.3 is traded by the retailers. Why non-commercial traded 5.2? 5.2 traded, they traded 5.2 per day. So now I'm going to be showing you things that you need to know as a retailer and what you need to know, how you need to follow, how you can follow up your trading with non-commercial, how you can follow the way they are trading step by step in this video. Now, there are 3 secrets to become a full-time trader here. 1, understand the psychology of trading. 2, understanding the true market structure so that you can buy and sell appropriately. And 3, entry is everything. Yes, entry is everything. Your entry is everything. Know your model. Know your model. Know your liquidity entry. Entry is everything. Very important. And I'm going to be talking about liquidity entry. Very important. This is a very powerful topic that you cannot miss. Now, what is psychology of trading? It is not about strategy that determine your profitability in the market, but your psychology. Your mindset in this market. Forex is not a gambling. Forex is not bet Nigeria or whatever. One thing you have to understand in Forex is that it is not, and that is first thing you have to understand here. Summary of trader psychology phase. You have to understand that your only edge is your risk management. I will come to that. Before this one, I want to let you know that Forex is not a gambling. Forex is not get quick money. You understand this before. You lost money in your business. You know, to let me rush to Forex. Maybe I can quickly recover what I lost. No, you will lose more money. Forex is not gambling. It's not, let me just jump into the market. Okay, this candle is moving faster. Let me move into it. No, no, that is not Forex. That is not Forex. That's not Forex. It's not like that. Now, you must understand that Forex is all about buying and selling of currency pairs, currency, different kind of country currency. And you must understand when to buy and when to sell. That is why your strategy is very important. But it's not about strategy, it's about your mindset. What is your mindset? What kind of mindset do you bring into the system? Do you want to make, you want to talk 100,000? Your mindset is you want to $100 to $1,000 in a day. No, you will lose that money. Your mindset should not be you want to get it quick, 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 quick. No. When you come into Forex like that, you will always lose money. Now, the only person you can conquer in Forex is yourself. Conquer yourself. When you are able to conquer yourself, control yourself, then you are good to go. So don't jump into market anyhow. And you don't need to trade all day. No, that is not about Forex. If you understand your strategy very well, you trade in a few days, in few time in a day, and not trading all currency pair you see. You specialize in some, very few, very few. Are you getting me now? So now you are the best to take care of your account, not another person. Very important. That is part of the psychology. You are the one that can take care of your account, not another person. You are the one that can manage your account. Now, second thing, that control your risk by yourself. That is risk management. Now, you must not lose more than 1 to 2% of your capital in every given trade. If you enter a trade, you must make sure that you are not losing more than 1 to 2% of your capital. If you are losing 20% of your capital in a trade, that means you are not serious. You don't know what you are doing. You are trading with $100 and you already placed 5 positions. No, you will lose money. Anything below $500 trading, your position should be 1 or 2. If you are trading 500 with $500, your position in a very given trade is supposed to be only 1 or 2 trade, and your lot size to be 0.01 and 0.03. You must not pass that range. You are trading with $100. That is what is called risk management. You are trading with $100. You go and put 0.05 with $100. One pull back against you will wipe that money from you. And you go and put about 3 or 4 positions. No. You have to grow that $100 gradually with one position and with risk management. You don't allow your lot size to be too bigger. Are you getting me now? So you have to know how to control your lot size. Go for low macro lot size, which is 0.01 to 0.09, but don't go for anything between 0.01 to 0.303. If you are trading with $500 below, anything $500 below, you must not go above 0.03, and you must not take more than 2 positions in a trade. That will preserve your account. That will make you not to lose money easily. Are you getting my point now? So I said, Forex is not gambling, but about buying and selling of currency. Yes, I've said that one before. Then your lot size. then you should not risk more than 1 to 2% of your capital in a trade. Then another thing is that you must understand risk ratio reward. When you are risking $1, you must have in mind that at least I must have reward of 3 or 4 or 5 dollars. You must multiply. You must have the profit. Your profit must be about 3 or 4 times your loss. Meaning, if I am going to lose $1 in this trade, if it turns to my direction and I'm going to win, I must be able to win like $4 or $5 in this trade. Meaning, your reward must be higher than your loss. Not that your loss is higher than your reward. In a trade, what you set your setup in a trade is showing that if you lose, you will lose $20. If you win, that is your take profit. You will win $10. No, it's wrong. It means your take profit should be higher than your stop loss. The pips of your take profit should be about 3 or 4 or 5 or 15 or 20 times your stop loss. So if you are losing, you lose low, you lose very small. If you are gaining, you gain more. That is how it is. That's how it is. You gain more than you lose. So you must understand this. It is not the amount of position you trade per day, or per week, or per month. No, it's not the amount of position. You can take just few position, one or two position in a day or in a week, and it is okay for you. It is not that you pack thousands of positions and all of them are, majority of them are in loss, very few of them are in profit. No, your psychology is having problem. Your psychology is having problem. Then you must learn how to jotter. Get jotter your trade. Don't just trade blah blah. You don't know, you lose money. You don't even know the reason why you lose that money. Write it down. Why did I lose that money? Okay, I took 5 trades with $100. Ah, that is my mistake. Jot it down. That is your mistake. So next time you are trading, you will not know that I made this mistake. Oh, I will not go back to it again. Okay, why did I lose that money? Why? You must write it down. Get a note. As I'm talking to you, I have a note for my trade, for my job, where I record all my details, daily trade details. Are you getting me now? Okay, why do I lose that money? Oh, I enter at the wrong entry. Where I enter the market is very wrong place. I did not enter at the right point. That is the reason why I lose that trade. So next time, you will not make that mistake again. Why is it important to jot down your trade? Because you can correct yourself and not do the same mistake again. It's very important. Jot down your note. Avoid greed. This forest, I've said this before. Avoid greed. Don't say, I want to make it. No, 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 no. I want to get it. No, 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 no. No. You will always what? Lose money. Be patient. If you are just 3 months, 4 months, 5 months in trading, some people are there for 5 years, so for 8 years, they be trading. Are you getting me now? So you just start trading. Don't say you want to make everything now. Understand the process first. In fact, I will advise you the first 6 months of your trading, don't use your real account. Use your demo account to be practicing. Even the first 1 year, be practicing first. Practice enough. Get enough understanding knowledge. Gather knowledge around this market. Understand how it works. Understand how to buy, how to sell. Understand it very well before you start using your real account. Because if you don't understand it, you will become a liquidity, which I'm going to explain later. You become a liquidity that the non-commercial banks or other retail trade will take you out of the market, will eat you up in the market. Are you getting my point now? Don't come to forex because of many needs. Your house rent, your marriage, you just want to graduate, you need money. Don't have that mindset. Your mindset must not be in that direction. That's the psychology. Your mindset must not be, I want to rush to marry. People are making money. Let me rush there. People are making money there. No, no, it is not there. Don't try it. It is not. So now you must understand all this. Risk management is the key. Control your risk. Don't Don't enter market anyhow. And don't trade morning, midnight, US section, Asia section, Europe section. No, 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 no. You can focus on just one section or two, one or two. Then leave the rest. Then, not that you must place 20 trade in this one, and that 20 trade in that one. No. Because the profit you make in Asia, US section can take it from your hand. If you are trading like that. If you make profit in Asia, forget that day. Don't enter market that day again. Forget that day completely. You have made some money. Relax yourself. Don't enter market that day again. Because the joy of making money will make you to enter that market wrongly and waste that money you just made. The money will just go. So if you have made small money, you are trading with other dollar. You make $20, $30, $40 in a day. What are you looking for? Do you know how much $30 in your country money? Some money you just get free. $30, $40. But some people, after they make $30, $40, it's greed. Greed will now tell them, go again. You will now go again. The market will now go against to wipe that $30, wipe your capital. Are you getting my point now? So you have to learn to journal your trade. I've explained this. Journal your trade. Make sure your trade is journaled. Then trade few pairs, even at fewer time. I've explained this. Don't trade all the pairs. You will see this one, you enter, you see that one, you enter. Let me tell you, very few pairs you can trade, like GBP USD, Euro USD, USD JPY, gold, US oil. These are few currency you can trade. You can focus on these four: GBP USD, Euro USD, USD JPY, gold, and oil. This is five. At least five. Or you can choose your best, the one you know that it is best to you. I just told you the one I normally focus on. You can choose your best. At times you can focus on one. I have some trader, they don't trade other currency. They focus on one trade. They focus on one trade. Are you getting that? So then they don't trade all the time. They trade few time. They use few time to trade. Once they get what they're looking for in that day, they forget about it. In fact, some people have journal, they know their target. Okay, my target is that I must make $50 per day. Once you make $50 per day, what are you looking for again? You are trading with $100, you make $50. That is 150. Tomorrow start again. Increase it gradually. But you want to turn down $100 to $1,000 in a day. No, you will lose that money. It's not like that. Have a trading bodo or community. That this is very important. Join a community where you can rub mind together. Join a group where you can ask questions. I don't understand it. Can you somebody explain this to me? It's very important. So very, very, very important. So now I am going to be going step by step to some other thing, which is I've done psychology. So your psychology is very important. Your mindset, the one you bring to market, is very important. Yes, this video you can download it on YouTube, and listen to it over and over again. If you download it, it will be easy for you to see on your phone. You can download it on your phone. Then if you have a phone that does not have space, download it, and when you have watched it, delete it so that you can get space for another video. Now, I'm going to be going to some points which are very important. Market structure, I've explained this one before in a former video. Market structure, we have three important market structure. We have up trade and we have down trade, and we have consolidation. You know that one? Consolidation, where you will have market will be consolidating like this. Now, in to explain that, this is higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low. Then we have lower high, lower low, lower high, lower low, lower high, lower. Market move like that. Market move impulsive, correction, impulsive, correction, impulsive, correction. There must be correction. And what is the purpose of that correction? I'm going to explain it in the course of this video. What is the purpose of correction? Is to gather liquidity to keep moving. In an up trade, which you can get in your daily time frame, 4 hour time frame, and 1 hour time frame. You can easily get the trend of your market daily, 4 hour, 1 hour. But the most important one is daily and 4 hour, 4 hour. So you can easily get the trend of your market. Now, the importance of this trade is to let you know that the market is going upward, up trade. But the market will not just go up trade like that. There must be impulsive movement, then there must be correction. Impulsive correction like that. The same thing here. But when market is going to reverse back from bullish to bearish, so I cut this thing out from here. I cut this one out. No, this turning back is what I cut out here. Now, how do you know that this market want to turn back? This move is this one. Then this move is this one. Then this move is this one. Then this move is this one. So let us now talk about this one. This is trade change from bull to bear. Why this one trade change from bear to bull? Now, by the time, how do you know that this market has changed? Because we also call it change of character or break of structure. So I think I explained that one. I wrote that one here. Here, I call it break of structure, change of character. Break of structure, change of character. What do you mean by break of structure and change of character? It means the market move like this, come back here to gather liquidity. I will explain the meaning of liquidity later, but that is very important. And move up to take out this high. Then once it take out, once this market take out this, the market this move take out this high and come down straight to take out this low. The high is taken out, the low is taken out to down trade. This one, it will now start forming higher, lower high, lower low, lower high, lower low, lower high. I will explain this to you in the chart. Are you getting me now? Once you see this, there is a change of character, meaning the market take out the high and take out the low. Take out the high and the low. See, the high now is taken out here. Taken out here. The low is taken out down trade. So this low has been taken out. This high has been taken out. The market has shifted, has changed character. The character of buying has changed to character of selling. Do you see the same thing happen here? If it is a down trade, if it is down trade like this is up trade, this is down trade. The market is coming from up here, it come up again, come a little bit, break this structure. This line you are seeing is break of structure, BOS, break of structure. Break it to to the down trade, then come back to break this structure up here. It break the high, break the lower low, break the lower high, break the lower low. The market has the thing has changed. So it means there is a change of character, change from bearish to bullish. This one will be changed from bullish to bearish. The trend change from bear to bull. So that is it. So it must take out the lower high, take out the lower low. You can see, look at it. This take out this, but there is nothing that take out. This one does not extend down here to take out this. Do you see it? This does not extend down here to take out this one. Look at this place. This is taken out by this. This higher high is taken out by this. But nothing take out this lower low. That is why it's still going up. Look at it now. The higher high was taken out. Higher low was not taken out. That's why you see this market still go up here. Higher high was taken out by the year. Higher low was not taken out. Higher high was taken out by this one. Higher low was not taken out. So there is still possibility that this market is still going to bullish. But here, when it comes to this place, higher high was taken out. Higher low was taken out. So there is a change. That's to tell you there is a change of character here now. Because higher high has been taken out, higher low has been taken out. So market has shifted. Market has shifted to another direction now. You get my point now. The same thing here. Higher low, higher low, lower low. Higher low was taken out by, higher low was taken out by this. Higher, lower low. Lower high, sorry. Higher low was not taken out. Lower low was taken out. Higher low was not taken out. Lower low was taken out. Higher low was not taken out. Lower low was taken out. It will continue like that until higher low was taken out. Lower low was taken out. That means there is a change of character. You see now, the same thing here. Higher low, higher high was taken out. Higher low was not taken out. Higher high was taken out. Higher low was not taken out. Higher high like that. Like that. Do you understand what I'm saying now? So now, let's move quick. Now, I've explained this thing in my last video, fair value gap. For it to be fair value gap, it must have 3 candlesticks like the 1, 2, 3. And this is what is called market inefficiencies. We call it market inefficiencies. So for you to understand market inefficiency, you must understand market efficiency. Market efficiency means balance in the market. Market is balance, equal buy and equal sell. If you look at this buy, this buy, this buy, this week low and this week low, we consider, when to find your fair value gap, you must consider the lower wick of this candle and the upper wick of this candle. If they connect with this line, if they connect, it means the market is balanced. It means there is equal sell and equal buy. Equal sell, equal buy. Are you getting me now? So there is no space here, no space here at all. That is what makes it balanced market. So when you see this one, there is no need for market to retrace back here to do anything here. Nothing to retrace here, nothing to retrace back here to clear. Market is already balanced here. But here, look at this week and look at this week. This week and this week, there is a gap in between. We are considering the candle before and the candle after this middle candle. Before it can be fair value gap, it must be 3 candles like this. 3 candles like this. Are you getting my point now? It must be 3 candles. The first candle, second candle, third candle, either bullish or bearish. Are you getting now? So now, when you see the wick of this candle, the lower wick of this candle, and the upper wick of this candle, when you connect them together and there is a space between them, that space is called fair value gap or imbalance or inefficiency. It means there is still a space that needs to be free. It means something, there is a buy that has not been sold. There is a good that is bought, but it's not yet sold. And in this market, there must be equal buy and equal sell, because forex market is a zero market. Zero market in the sense that there must be equal buy, equal sell. In a day, $7.5 trillion must be bought and must be sold. Some group must buy it, some other group must sell it. It must be equal. Are you getting me now? So, but for it to be fair value gap, there must be space. And let me tell you something. Every fair value gap must be clear, must be efficient, must balance. It's a matter of time. It may take 1 month, 2 months, 3 months, even 1 year for fair value gap to be clear. For instance, look at this one now. If you see this, you can even use this one as a very quick point of your entry. When you see fair value gap like this, and you already see market turning back, this market turning back is telling you that I am coming to fill this fair value gap because it must be filled. So the market can come, fill it a little bit, come up upon it, above it a little bit, and start selling. So when you see market turning back and you're already seeing fair value gap here, it's a signal to you that this market is coming to fill this fair value gap. And once it fill it, the market will turn to the other direction. Please, I want you to watch this video to the end because I want to say something about liquidity that is very, very important. So that is it. Now, this is the main thing in this video. After you understand fair value gap, I will explain it better in the chart. Now, liquidity and entry. What is liquidity? Liquidity is the fuel of the market. If you cannot spot them, you will become it. That is very important. If you cannot spot liquidity, then you will become a liquidity. What is liquidity? Liquidity is money. Liquidity is as your fuel to your car. If your fuel is not in the car, can you drive the car? No. Liquidity is money, is volatility. Liquidity is opportunity in the market. And without liquidity being taken, there will be no movement in the market. Without liquidity being taken, there will be no movement in the market. What moves the market is liquidity, money, fuel. I'm going to be showing you now in the chart. What non-commercial look for is liquidity. They look for where liquidity is gathered. And how do you know where liquidity is being gathered? Look at it. One, they are above and behind swing high and previous day, swing high, previous day, previous week, previous month, high or low. Above or below equal high and equal low. What is the meaning of that? What is all this thing telling us? Look at this. This is swing high. This is swing high. This is swing low, swing high, swing low, swing high, swing low. Liquidity is here. Liquidity is always here. Liquidity is always here. Liquidity is always here. Liquidity is always here. It's always here. It's always here. It's always here. It's always here. Liquidity is all this place you are seeing. That is a place where market will go to go and gather liquidity before it will continue either bullish or bearish. If you can understand this thing I'm telling you now, I am telling you, you will not have problem in trading anymore. If you cannot spot liquidity, you will become liquidity. If you cannot spot liquidity, you will definitely become liquidity. Because they are the movement of the market. So liquidity rests above every high and low. Liquidity rests above the equal high, meaning double top or double bottom. You understand this thing? You know your W is double bottom, your M is double top. Liquidity rests above them. There is liquidity here now. Here in this place, there is liquidity here. Here, there is liquidity here. And that is what this market come and take out. Non-commercial, they are hunters of liquidity. And you too must be an hunter of liquidity. A professional trader must be an hunter of liquidity. They trade themselves to only trade when the liquidity has been taken. They don't trade when liquidity has not been taken. I will explain this, please. I will explain this very well. They don't trade when the liquidity has not been taken. So train yourself like them. Trade only when a bulk of liquidity has been taken to increase your profitability. So when there is a sweep of liquidity, when there is liquidity sweep, when non-commercial has swept a particular liquidity, then that is the very right time to enter the market. And I told you, where can you find them? You can find them in all where you can see your stop loss, take profit, buy bid, buy limit, sell limit, sell stop, buy stop. That is where you see liquidity. Everywhere you see people set their stop loss, take profit, that is where liquidity are. You see, look at it now. If you place a trade there, your stop loss will be around a little bit low, isn't it? And that is where liquidity is. That around play. That is where liquidity. It means not only you is taking that trade, maybe thousands of traders are taking that same trade. So their liquidity, their stop loss is here. So the market will come back to sweep that liquidity. Once that liquidity is swept, then it will return back again. So you wait for that liquidity to be swept before you enter buy. For instance, now look at this. This market is going up. Come here to come and clear a liquidity here before it started going up. Come back to clear liquidity here before it started going up. Come back to clear liquidity here before it started going up. Like that. That is how it is. So there is a liquidity in this place. Liquidity here, liquidity here. So market must always turn back to clear liquidity before they started going up, going further. Let me quickly move on very fast in this explanation. So liquidity is the master, is the most important thing you must understand here. I'm going to make this video two video so that it can be easily understood. So I will use this one and I will do the other one with you have to listen to the second one to make you understand this thing very well. Now they are above. Now I've explained this one. Now I'm going to explain this thing in two scenarios. One. Now there is something we call analogy of swings plus EPD. EPD means equilibrium, premium, and discount. Equilibrium, premium, and discount. That's the meaning of that one. Now, equilibrium, premium, and discount. Now, let me explain something about discount to you. This is very, very important. Very, very important. I have to explain this because this is the note to this trading. What is premium? What is discount? This is up trade. This is down trade. Now, in this up trade, market move. In an up trade, come back to gather liquidity here to continue up trade. Now, if you look at here, this is an impulsive move. Very momentum, long momentum, long candle. This may take about 4 or 5 candles at times for buy. This is sell. Now, how do you know the middle of if you want to enter buy again? You want to enter buy again. How do you know where to enter buy? You enter buy if market is going like this. You don't enter buy at this point. You wait for market to retrace to below 50%. Below 50% is called discount. Above 50% is called premium. That is sell zone. Below it is called buy zone. Meaning, when market is moving like this and it is traced back, just like what I explained here, this thing here now, this thing. How do you know where to buy? Because you can buy here, you can buy here, you can buy here. Because I told you liquidities are here. When you are buying here, your stop loss is already in all this place. So all these are liquidity point. Liquidity point. So now, how do you know where to buy? You don't buy at premium, you buy at discount. Because commercial, not commercial, they buy at discount and sell at premium. That is something you have to understand. They don't sell at discount. They sell at premium. Meaning they sell high. You know, this is high, this is low. If you look at your price is going from down up. So the price here will be higher than the price here. So they will sell at higher price. They will buy at lower what? Lower price. They buy at lower price because if you are counting 10, 20, 30, 40, 50, 60 here now. So they buy at 10, they sell at 50. Do you see it now? Do you see? So they don't, this is their secret. I'm showing you their secret. And you have to follow them. How do you know this is your 50%? Use of Fibonacci retracement. Fibonacci retracement, put your cursor here, drag it to this end here. The 50% level is your equilibrium. It's called equilibrium. 50% level is called equilibrium. Then anything above that 50% is premium. Anything below that 50% is discount. Are you getting me now? When you put your Fibonacci here to this place, it will show you 28, 38, then show you like that. 50%, 61.8. That is the number one. So most of the time, they sell at that 61.8. I will explain this through the chart very well so that I can understand it. But anything above 50%, they can sell. And anything below 50%, they can buy. Do you see now? So buy at discount is below 50%, which is your P. D. So sell at premium is your P. Equilibrium is your E. So this equilibrium is very, very important. You have to understand it. Very, very important. You have to understand it. I say when market move like this, it will move up like that. So the middle of this huge movement is 50%. If it trace, it's going to trace back. That tracing back, so for them to buy again, it will be a little bit around 50%, under 50%. So that is it. You understand that one now? Now, in this scenario, I'm going to let me explain this. This is very important. This is very, very important. Very, very important. This is what's called BOS, your change of character, where you can have breakups. This is break of structure. Now, this is a key in entry the market. Please, this is a key. Please listen to this. Very, very important. I am going to make this video, so please you have to listen to the second video. The second video is going to be purely chart, which I'm going to use to explain everything about what I just explained now. The chart, I will use it to explain everything I just explained now. Now, the market move downward, say, then all of a sudden, market move up. And this up is a break up. This, when you look at this, where the market is coming from, there's a break of structure here. Market break the structure here. And this market that break the structure, move straight. How do you know that it break the structure? Use your line to draw this line from where the market starts here to where it break the structure. The structure has been broken. Now, the market has broken the structure at the up trend. It will return back to break the, we have higher, higher high, higher low. This is higher high, higher low. So the market must break the higher high and break the higher low. Once that happens, you must enter your market around this place. This is a secret I'm showing you now, and I will show you very well in the chart. Once market break the higher high and higher low to gather liquidity. So this coming here now, I told you this is liquidity. This is liquidity. This higher high is liquidity. This one is liquidity. There's a lot of liquidity here. A lot of liquidity here. So the market is coming from back here to clear this liquidity. It means when I say liquidity, a lot of stop loss here, take profit here, a lot of stop loss. So a lot of buy stop and sell stop, buy limit and sell limit here. So the market is buying, is selling, So your stop loss is around this place. Market will turn back. The commercial will come and sweep. They will come and sweep all the stop loss here. Not that they want to buy. They are coming to gather money from you so that they can continue their sale. Are you hearing me now? So, but this is how it is. Once they break it up and they break it down, note that these people, they want to actually buy. Actually, they want to buy. They want to buy. They will not buy in a long way. And I've explained this to you, double bottom. You see, double bottom. 1, 2. But I'm showing the secret behind it now. Why it become double bottom? 1, 2. And I told you, you always enter at your second bottom or third bottom. Why this thing become the second bottom? The market went to clear the liquidity here to break the structure and come back to clear the liquidity here to break the structure also. Just close the door. Are you getting me now? So the market come now to break the structure here and break the structure here. Once that two happen, this market will turn back to buy. The same thing if it is for sale. Market is moving from downstairs, down trade, then return back to break the structure, to break the structure. I've explained breaking of structure to you. Once this breaking of structure happen, wait for market to retrace back. So you can see, you can see that once the market come here, break the structure downstairs and break the structure upstairs, the market will start selling again. I will explain this thing very well in the chart to you. Once the market break the structure down here, expect the market to retrace back to go and take that higher low. This market already taking the lower low. The lower low is already taken by this. Then the higher low is here. This higher low, lower low. This is higher high, higher low. The market must take the higher high and take the higher low. Then it will begin to go, but it will start going to the correct direction. And this is what is called accumulation. This is accumulation. It will accumulate around this place. Then manipulation, accumulation, manipulation, and distribution. AMD. Accumulation, manipulation, and distribution. And we call it ABC. We name it ABC. This is your A, this is your B, this is your C. Once you see your C, you enter your trade. Enter your trade here. Enter your trade here. This is your ABC for sell, for sell. ABC. Once you see the market coming back to take this this higher low, enter your sell there. And you can see it's also double top. You see, the reason why double top is very important. Double top, double bottom. The reason why some double top are valid when you enter it will work is because the market break the structure downstairs here and break the structure upstairs here. At times it will go up a little bit. And what is the extent to which this thing can go? This one can break, can break. It is when you have fair value gap here or other block. I will explain that one in the chart. Then the second scenario is when the market come down and the market, you see the market here, the market go up like this. Then the market now come to form another small internal structure here. You know, this one goes straight. Market wham, wham, market move to break the structure straight. But this one now is forming another internal structure, small structure here. Don't expect the market after it has broken the down structure. Don't expect the market to go back to this one like it went back, like this one went back to this place, to this place. No, don't expect it. The market can retrace back to start selling from the, because this one now is telling you that this is a strong this one has been already protected. This one protect this one. This one has protected this one. So the only way you can see this market going up is if there is fair value gap here. It will come to clear that fair value gap before it started retracing back. But if there is no fair value gap, it will return back from this second one. And if you look at it also, it's still your double top or triple. You can say 1, 2, 3. Your triple, you can call it your triple what? Bottom. 1, 2, 3. Triple top. And this is a triple what? Bottom. 1, 2, 3. You see it? 1, 2, 3. So don't expect this one to come to this place or this one to come to this place. It may stop at this place, stop at this place, and start going up. You see it? So once you see the market coming down, forming first bottom, and it goes to form, go a little bit to form second small bottom. This one is going to break this structure where this one is coming from. Once this structure is broken, it will come back not may not come back to this bottom, direct bottom, but we stop at this other bottom and start going up. I'm going to stop this video here. This is already 15 minutes. I will stop it. This video is going to be on YouTube so that it will be easy for you to download and to watch again and again. I will do the second video and I want you to watch it again. There are two videos that I will use. So in this second video, I will explain what I mean by premium, discount, fair value gap, order block, breaker block, break of structure, change of character, top down analysis, and this and any other thing that I need to explain to make you understand this. This is a secret. This is how commercial market trade. Please make sure you watch the second video that will explain to you better. Thank you. God bless you.